Hey everyone, and welcome back to the channel. Today, we're diving deep into UDIV, a dividend ETF that's been making serious waves lately. According to ETF.com, UDIV has delivered a whopping 30% return in just the last year. That's right, 30%, while potentially providing a steady stream of income through dividends. Sounds too good to be true, doesn't it? Well, we're here to uncover the secrets behind UDIV's explosive performance. Is it a dividend dream come true, or is there a hidden danger lurking beneath the surface? We'll be analyzing UDIV's investment strategy, its risk profile, and how it might fit into your overall investment goals. So, whether you're a seasoned investor or just starting out, stick around to find out if UDIV deserves a spot in your portfolio. Let's crack this open and see what UDIV is all about. What is UDIV ETF? UDIV, or the Franklin U.S. Core Dividend Tilt Index ETF, is an exchange-traded fund designed to track the performance of an index that focuses on companies with a history of paying dividends. Here's a breakdown of its key features. Investment objective. Generate returns by investing in large and mid-cap U.S. companies with a strong track record of paying dividends. Investment strategy. Unlike traditional dividend ETFs that simply weight holdings based on their current dividend yield, UDIV employs a tilt strategy. This means the index it tracks considers factors beyond just current yield, potentially including dividend history. Companies with a long history of consistently paying dividends are likely to continue doing so. Dividend growth. Companies that have a history of increasing their dividend payouts over time are favored. Financial health. The financial stability of the company is important to ensure sustainable dividend payments. Benefits. Potential for regular income. Owning UDIV allows you to participate in the dividend payouts of the underlying companies, providing a potential source of regular income. Growth potential. While dividend-focused, UDIV's holdings are also large and mid-cap companies with the potential for capital appreciation alongside dividend income. Diversification. By holding a basket of companies, UDIV offers diversification, mitigating risk compared to owning individual dividend stocks. What is the expense ratio of UDIV compared to other dividend ETFs? The expense ratio is a crucial factor to consider when evaluating any ETF, including UDIV. It represents the annual fee charged by the fund manager to cover operational costs. A lower expense ratio translates to a higher percentage of your returns staying invested in the ETF. Here's a breakdown of UDIV's expense ratio compared to other dividend ETFs. UDIV expense ratio. As of May 20, 2024, UDIV's expense ratio is typically around 0.24%. Comparison with other dividend ETFs. Generally, dividend ETFs have slightly higher expense ratios compared to broad market ETFs due to the active management involved in selecting dividend-paying companies. Here's a range of expense ratios for various dividend ETFs. Low expense ratio, under 0.2%. Some dividend ETFs, particularly those tracking broad dividend indices with minimal active management, can offer expense ratios as low as 0.10% to 0.20%. Average expense ratio, 0.20% to 0.40%. This is a common range for many dividend ETFs, including UDIV. High expense ratio, above 0.4%. Actively managed dividend ETFs that focus on specific sectors or have complex selection criteria might have expense ratios exceeding 0.4%. Here are some popular dividend ETFs with their expense ratios for comparison, as of May 20, 2024. Schwab US Dividend Equity ETF, SCHD 0.06%, very low expense ratio. Vanguard High Dividend Yield ETF, VYM 0.09%, low expense ratio. SPDR SP Dividend Aristocrats ETF, NOBL 0.35%, average expense ratio. iShares Core High Dividend ETF, HDV 0.38%, slightly above average expense ratio. Global X Super Dividend ETF, SDIV 0.85%, high expense ratio due to its global focus. Impact of expense ratio. While a 0.1% difference in expense ratio might seem small, it can significantly impact your returns over time, especially in long-term investments. For example, a 0.24% expense ratio on a $10,000 investment translates to $24 annually, which reduces your potential returns. How liquid is UDIV compared to similar ETFs? Liquidity refers to how easily you can buy and sell an ETF at its fair market price. Here's a detailed analysis of UDIV's liquidity compared to similar dividend ETFs. Factors affecting liquidity. Average daily trading volume, ADTV. This metric indicates the average number of shares traded daily. A higher ADTV signifies better liquidity. Bid-ask spread. This is the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share. A smaller spread suggests better liquidity. UDIV's liquidity. UDIV generally has a moderate level of liquidity. While not the most liquid dividend ETF, it allows for buying and selling shares efficiently without significant price impacts. Comparison with similar ETFs. Large cap dividend ETFs. Large cap dividend ETFs like SCHD, Schwab US Dividend Equity ETF, and VYM, Vanguard High Dividend Yield ETF, often have very high ADTVs due to their popularity and broad holdings. This translates to excellent liquidity. Mid-cap dividend ETFs. Mid-cap dividend ETFs tend to have lower ADTVs compared to large-cap options. However, some popular mid-cap dividend ETFs like MDI, SPDR SP Mid-Cap 450 High Dividend Yield ETF, still boast high liquidity. Sector-specific dividend ETFs. These ETFs, focusing on specific sectors like financials or utilities, might have lower liquidity due to a smaller investor base. What is the sector allocation of UDIV's holdings? Unlike some traditional dividend ETFs that might simply weight holdings based on their current dividend yield, UDIV employs a dividend tilt strategy. This means the index it tracks focuses on additional factors beyond just yield, and the sector allocation might not directly reflect the broader market. Here's a breakdown of understanding UDIV's sector allocation. UDIV's underlying index. UDIV tracks the sole active U.S. Core Dividend Tilt Index. This index doesn't publicly disclose its exact sector allocation, making it difficult to pinpoint the precise weightings of each sector within UDIV. General insights. UDIV is likely to be invested in a diversified basket of sectors, focusing on companies with a history of paying and potentially growing dividends. Given the focus on large and mid-cap companies, sectors like financials, consumer staples, healthcare, and utilities might have a significant presence due to their prevalence of dividend-paying companies. Sectors with high growth potential but lower dividend yields, like technology or communication services, might have a smaller allocation compared to their weight in the broader market. How concentrated are UDIV's holdings in terms of the number of companies? UDIV falls somewhere between a broadly diversified dividend ETF and a more concentrated one targeting a specific number of holdings. Here's a detailed breakdown. Number of holdings. As of May 20, 2024, UDIV doesn't disclose a specific number of holdings on its official documentation. However, based on industry analysis and comparisons with similar ETFs, UDIV likely holds somewhere between 250 and 500 companies. Comparison with other dividend ETFs. Broadly diversified dividend ETFs, 1,000 plus holdings. Some dividend ETFs, like SCHD, Schwab US Dividend Equity ETF, or VYM, Vanguard High Dividend Yield ETF, hold thousands of companies, offering exceptional diversification. Concentrated dividend ETFs, less than 100 holdings. These ETFs, focusing on specific dividend strategies or sectors, might hold a much smaller number of companies, potentially increasing risk due to lack of diversification. Benefits of UDIV's holding concentration. Reduced management complexity. Compared to ultra-diversified ETFs, a holding range of 250 to 500 allows for more focused management and potentially better selection of dividend-paying companies. Enhanced focus on dividend tilt strategy. A slightly smaller number of holdings allows UDIV to potentially apply its dividend tilt strategy more effectively, focusing on companies with a strong history and growth potential for their dividends. Potential drawbacks. Lower diversification. Compared to broadly diversified options, UDIV's concentration increases its vulnerability to the performance of individual companies within its holdings. Sector bias. While the exact sector allocation is unclear, UDIV's focus on dividend-paying companies might lead to a bias towards certain sectors with higher dividend yields, potentially limiting diversification across different industries. Does UDIV consider future dividend growth potential when selecting companies? Yes, UDIV's dividend tilt strategy likely places a significant emphasis on a company's future dividend growth potential when selecting holdings. Here's a breakdown of the evidence. The dividend tilt philosophy. UDIV aims to go beyond simply selecting companies with high current dividend yields. It focuses on companies with a strong track record of paying dividends and, crucially, the potential to grow those dividends over time. Evidence for future growth focus. Focus on dividend history. Companies with a long history of consistently paying and potentially increasing their dividends demonstrate a commitment to shareholder payouts. UDIV prioritizing such companies suggests it values future growth potential. Not just high current yield. While current yield is a factor, UDIV doesn't solely focus on companies with the highest current payouts. This suggests it looks for long-term sustainability and growth prospects for dividends. Underlying index philosophy. The sole active U.S. Core Dividend Tilt Index, which UDIV tracks, likely incorporates future growth potential into its selection criteria. Public disclosure limitations. The exact weighting methodology of the index isn't publicly disclosed. We don't know the precise importance assigned to future dividend growth potential, compared to other factors. What is the frequency of UDIV's dividend payouts? UDIV offers a regular stream of dividend payouts to its investors. Here's a detailed explanation of its payout frequency. Quarterly distributions. UDIV is designed to distribute dividends to shareholders on a quarterly basis. This translates to 4 dividend payouts throughout the year. Target for payout. The exact amount of each dividend payout can vary depending on the ETF's performance and the underlying company's dividend distributions. However, the objective of UDIV is likely to distribute a significant portion of its collected dividends to shareholders. Benefits of quarterly payouts. Regular income. Quarterly payouts provide investors with a predictable stream of income, which can be particularly attractive for retirees or income-oriented investors. Compounding potential. If you reinvest your dividends into additional UDIV shares, you can benefit from potential compounding growth over time. Does UDIV reinvest its dividends, or are they distributed to shareholders? UDIV itself doesn't directly reinvest its dividends. Here's a breakdown of how UDIV handles dividend payouts. Distribution to shareholders. UDIV is designed to distribute a significant portion of its collected dividends to shareholders on a quarterly basis. This aligns with its objective of providing investors with a regular stream of income. Investor choice for reinvestment. The decision to reinvest the dividends lies with the individual shareholder. Many investment platforms offer the option to automatically reinvest dividends received from ETFs like UDIV. This allows investors to benefit from potential compounding growth over time. Benefits of reinvesting dividends. Compounding growth. By reinvesting your dividends, you purchase additional shares of UDIV. As the ETF's price, and potentially dividends, grow over time, your overall returns can be amplified through compounding. Dollar cost averaging. Automatic reinvestment can help with dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the ETF's price. This can help average out the cost per share over time. Alternatives to automatic reinvestment. Investors can also choose to receive their UDIV dividends in cash and then manually reinvest them into the ETF or other investments if they prefer more control over their investment decisions. How does UDIV's dividend distribution strategy compare to other dividend ETFs? UDIV's dividend distribution strategy has some key differences compared to other dividend ETFs. Here's a breakdown of the comparison. UDIV strategy. Focus on dividend tilt. UDIV goes beyond simply prioritizing high current yields. It selects companies with a history of paying and potentially growing dividends, aiming for a sustainable income stream. Quarterly distributions. UDIV distributes dividends to shareholders on a quarterly basis. Distribution of collected dividends. UDIV aims to distribute a significant portion of its collected dividends, prioritizing shareholder income. Comparison with other dividend ETFs. High current yield ETFs. These ETFs prioritize companies with the highest current dividend yields. While they might offer a larger initial payout, the sustainability of these high yields can be uncertain. Example: if a company needs to cut its dividend due to financial difficulties, the income stream of a high current yield ETF could be negatively impacted. Broad market dividend ETFs. These ETFs track broad market indices that include dividend-paying companies. They offer diversification but might not prioritize companies with a strong track record of growing dividends. Example: a broad market dividend ETF might hold some companies with a history of stagnant or even declining dividends. Actively managed dividend ETFs. These ETFs employ active management strategies to select dividend-paying companies. They might have higher expense ratios, but could offer more flexibility in targeting specific dividend characteristics. Example: an actively managed dividend ETF might focus on a specific sector known for high and sustainable dividend yields. How does UDIV's risk profile compare to other dividend ETFs and the broader market? UDIV's risk profile compared to others. Understanding risk. Dividend ETFs, like UDIV, generally involve less risk compared to non-dividend paying stocks because they offer a buffer through regular income payouts. However, they still carry inherent risks. Factors affecting UDIV's risk profile. Focus on dividend-paying companies. UDIV's holdings might be less volatile than growth-oriented stocks that don't pay dividends. This can contribute to a lower overall risk profile. Concentration versus diversification. While UDIV likely holds a basket of companies, potentially 250 to 500, it might be less diversified than a broad market ETF holding thousands of stocks. This concentration can increase risk if a specific holding performs poorly. Sector bias. UDIV's dividend tilt strategy might lead to a bias towards sectors with higher dividend yields, like financials or utilities. These sectors might grow slower than the broader market, impacting UDIV's overall growth potential. Comparison with other dividend ETFs. High current yield ETFs. These ETFs might be riskier due to their focus on companies that might be financially weaker and more likely to cut dividends. Broad market dividend ETFs. These ETFs offer broader diversification, potentially lowering risk compared to UDIV's concentration. However, they might hold companies with stagnant or declining dividends, impacting income potential. Actively managed dividend ETFs. These can be riskier or less risky depending on the specific strategy. Some might focus on volatile high-growth sectors alongside dividends, while others might prioritize stability. Broader market comparison. The overall stock market is inherently risky, with prices fluctuating based on various factors. UDIV might offer slightly less risk than the broader market due to its focus on dividend-paying companies. How does UDIV's performance correlate with other asset classes? UDIV's correlation with other asset classes. Understanding correlation. Correlation measures the degree to which two investments move in tandem. A correlation coefficient of 1 indicates perfect positive correlation, both move together, -1 indicates perfect negative correlation, opposite movement, and 0 indicates no correlation. UDIV's potential correlations. Stocks. UDIV, like most stock ETFs, likely has a positive correlation with the overall stock market. When stock prices rise, UDIV's price is likely to rise as well. Conversely, a stock market decline can lead to a decrease in UDIV's price. Bonds. Historically, stocks and bonds tend to have a negative or low positive correlation. This means that when stock prices fall, bond prices might rise, and vice versa. Therefore, UDIV might have a low negative or even a slightly positive correlation with bonds. This can provide some diversification benefit within a portfolio. Real estate. Real estate investment trusts, REITs, share some characteristics with dividend-paying stocks. UDIV might have a somewhat positive correlation with REITs, although the strength of the correlation can vary depending on economic conditions and specific REIT sectors. Commodities. Historically, there's often a weak or even negative correlation between stocks and commodities like gold. Therefore, UDIV might have a weak negative correlation with commodities, potentially acting as a hedge during periods of market turmoil. Factors affecting correlation. Economic conditions. During economic booms, all asset classes might rise together, increasing correlations. Conversely, recessions can lead to negative correlations as investors seek different asset havens. Interest rates. Rising interest rates can negatively impact stock prices, including UDIV, but might benefit some bond funds. This can affect the correlation between UDIV and bonds. Importance of portfolio diversification. UDIV's correlation with other asset classes can fluctuate. Including UDIV within a diversified portfolio that also holds assets with potentially low correlations to stocks, like bonds or commodities, can help mitigate overall portfolio risk. What are the potential risks associated with a dividend-focused investment strategy? While a dividend-focused investment strategy like UDIV can offer compelling benefits like regular income and potentially lower volatility, there are also inherent risks to consider. Focus on current income over growth. Lower overall returns. Companies that prioritize high dividend payouts might reinvest less capital for future growth. This could potentially lead to slower share price appreciation compared to companies that focus on reinvestment and growth. Missing out on high growth opportunities. A strict focus on dividend-paying companies might cause you to miss out on investing in younger companies with high growth potential but no or low current dividends. Sustainability of dividends. Dividend cuts. companies can cut or even suspend their dividends altogether due to financial difficulties. This can significantly impact your income stream and potentially lead to a decline in the ETF's share price if investors lose confidence. Dependence on company performance. Your income stream relies on the financial health of the companies within the ETF. Economic downturns or industry-specific challenges can negatively impact these companies' abilities to maintain their dividend payouts. Tax implications. Taxation of dividends. Dividends are typically taxed at a different rate compared to capital gains, profits from selling investments at a higher price than you bought them. This can affect your overall return on investment. Sector bias. Limited diversification. Dividend-focused ETFs, like UDIV, might be biased towards certain sectors with a history of high dividend yields, such as utilities or consumer staples. This can limit your exposure to other sectors with potentially higher growth prospects. Vulnerability to sector downturns. If a specific sector favored by the ETF experiences a downturn, it can disproportionately impact the overall performance of the ETF compared to a more broadly diversified portfolio. Management fees. Expense ratios. Even though dividend ETFs generally have lower expense ratios compared to actively managed funds, these fees can still eat into your returns over time. Here are some additional points to consider. Investment time horizon. A dividend-focused strategy can be suitable for long-term investors seeking regular income. Over a longer timeframe, potential disadvantages like lower growth prospects might be mitigated by the consistency of dividend payouts and potential for share price appreciation. Risk tolerance. If you have a low risk tolerance and prioritize a steady income stream, a dividend-focused strategy can be a good option. However, if you have a higher risk tolerance and are focused on maximizing capital growth, you might consider a different investment approach. How might changes in the economic environment impact UDIV's performance? UDIV's performance can be influenced by various economic factors. Here's a breakdown of how different economic scenarios might affect the ETF. Economic boom. Stock market rally. During economic booms, the overall stock market typically experiences growth. This can lead to an increase in UDIV's share price as well. Potential dividend growth. Companies might be more likely to raise their dividends during prosperous times, benefiting UDIV's income stream. Economic downturn. Stock market decline. Economic recessions can cause stock prices to fall, potentially leading to a decrease in UDIV's price. Dividend cuts. Companies facing financial difficulties might cut or suspend their dividends. This can significantly reduce UDIV's income stream and negatively impact its overall return. Interest rates. Rising interest rates. Higher interest rates can make bonds a more attractive investment compared to stocks. This could lead to investors selling UDIV shares, potentially driving down its price. Lower interest rates. Low interest rate environments can make dividend-paying stocks like those held by UDIV more appealing to income-seeking investors. This could lead to increased demand for UDIV and a potential rise in its share price. Inflation. High inflation. Inflation erodes the purchasing power of dividends. Even if the nominal dividend amount stays the same, it buys less over time due to inflation. Companies adjusting dividends. Some companies might adjust their dividend payouts to keep pace with inflation, potentially mitigating the impact on UDIV's income stream. Sectoral impacts. UDIV sector bias. The ETF's focus on certain sectors with high dividend yields can influence its performance during economic changes. For example, utilities might outperform during recessions due to their perceived stability, while financials might struggle. Alright, to wrap it up, UDIV offers a compelling option for income-oriented investors seeking a balance between Regular dividend income. UDIV prioritizes distributing a significant portion of its collected dividends to shareholders. Potential for growth. The focus on companies with a history of paying and potentially growing dividends suggests a possibility for long-term capital appreciation alongside income. Moderate risk profile. While UDIV offers some advantages compared to non-dividend paying stocks, it still carries inherent risks associated with the stock market and the specific companies it holds. Remember, consider your investment goals, risk tolerance, and desired income stream before investing in UDIV or any ETF. Conduct your own research and don't rely solely on this video for investment decisions. Diversification is key. Consider including UDIV within a broader portfolio strategy to manage overall risk. Thanks for joining me today. If you found this video helpful, be sure to leave a like and subscribe for more in-depth investment analysis. Also, check out the description below for links to additional resources about UDIV and dividend investing.